So I want to thank you for joining the Road to Retirement webinar for Accenture Managing Directors. I'm Dan Myers, founder of Adventure Wealth Advisors. A few things we have to share before we get started. First, even though I still have my sweet Accenture mug, I'm no longer affiliated with Accenture in any way. Second, I'm a registered investment advisor, so I have to share the information and the content we're sharing in today's meeting is for informational purposes only and not specific to your situation. Now, I want to introduce you to Danny Myers. So I think a lot of us probably have these early Accenture name tags, the badges that we had to get when we started with the client. This was my first work badge. I was actually at SBC, not even around anymore. And I was out of the Dallas office. So I know we have some DFW folks joining us today. So glad to see you here. Danny was a target of a lot of ridicule at the time when they laughed about the Accenture school bus pulling up. I didn't really get it then, but almost 20 years later, I guess I get it now. So that was then, and this is now. So I spent 7 years at Accenture before I was hired away by a client. But within that 7 years, I amassed hundreds of thousands of Starwood points and lifetime platinum status, which I still believe is one of my best career accomplishments. And I think this partially caused the travel bug, which shortly after led us to a 1-year sabbatical where we traveled around the world. We were lucky to find success in our careers and achieve financial independence in our mid-30s. So we set out to design a lifestyle that we loved. That brings us to where we are today in Southeast Utah. We're about an hour and a half south of Moab, if you know this kind of Red Rock country area. We found a community that we loved, integrated into it, got involved in the arts. We helped host the local arts festival, but I always knew that there was more that I wanted to do. And that's the business that I have today. My mission now is to help other people find their life's adventure. So I came back to my original passion before Accenture, which is personal finance and investing. That's why we're here today. I consider myself a financial consultant to Accenture execs. So I choose to specialize in Accenture execs because I truly believe that you are the best of the best. I enjoyed my time at Accenture immensely, and I'm very thankful for the training and the education that I received there, even the time that I spent at the Q Center in St. Charles. I had great mentors along the way, and now I believe the way I can make the biggest difference is by enabling you. I do this by helping you find financial peace. This is different for people, and it changes throughout your life. For the new MDs I work with, it's figuring out the cash crunch after you make MD and you do the 30% into the VEIP, and you wonder why your paycheck is smaller than it was as a manager. For more experienced managing directors, it means helping them figure out the new MD grant when it's going to vest and how to balance saving for retirement versus saving for kids' college versus also meeting your equity requirements as a managing director. Then, of course, for everyone, it's creating a plan to help them achieve their life goals and find financial independence and secure retirement. My services are designed with Accenture Managing Directors in mind. The first one is financial planning, where I really consult with you on nearly every area that touches money in your life: investments, retirement planning, estate planning, education planning, insurance needs, all that good stuff. The second is investment management, where we do the financial planning, but on top of that, I manage your investments, removing the stress of you having to do that because I know you're incredibly busy. So that's enough about me. Let's get into some value that I think I can bring you today. We're going to cover three main things. The first is a quick overview of MD compensation. The next is talking about the two paths that I see most MDs take post-Accenture, which is either retirement or exploring financial independence. We'll talk about strategies for each of those. And make sure you stick around to the end. We're going to talk about specific items that you can do today to help you in your journey. And I will leave time at the end for a short Q&A. So most of you joining today are pretty senior, so you may know all of this already. However, what I find when talking to Accenture Managing Directors is that Accenture doesn't do the greatest job of teaching you about compensation. And instead, knowledge tends to be passed down through generations, and it kind of turns into a game of telephone. It's very complex. In fact, I have other financial advisors who call me who have Accenture clients and ask if I can teach them about MD compensation. So as you know, there's two main components. There's your cash component, which is pretty simple. It's your cash salary and your annual bonus. And then the other side, which is very important for MDs, is the equity component. This is what makes it worth it to be a managing director. There's three main ways that you get equity. The first is your new managing director grant. The second is your annual equity awards. And the third is the VEIP RSU grant. The new MD grant is a standard $175,000 grant when you make MD at L4, but this can rise pretty significantly if you're hired in from the outside as an MD. It's a standard 5-year cliff vest, which means all or nothing. If you leave early, you don't get any of it. So definitely a big incentive to stay. The second one is the annual equity award. It's awarded as part of the annual performance year. This is between 0 and 82%, depending on MD level. And it's a standard vesting cycle of 3 years where you get 1/3 per year. What might be important to you, and you may already know, is that this accelerates whenever you're over 50 years old. By the time you're 56, you actually get the entire vest 1 month after the award is granted. So that's pretty nice. The third is the Voluntary Equity Investment Program RSU grant. So as you know, you can contribute up to 30% of your cash comp, which includes your salary and your annual bonus. As long as you participate the full year, you're awarded a 50% RSU grant, which then takes 2 years to vest. There's a lot of nuances and strategies within these, but this is kind of what we'll cover at a high level. A lot of people will need to harvest cash from the VEIP. And so there's a lot of strategies where we would look into about what's the best way to do this to minimize taxes. You know, real simple example is making sure you're waiting at least a full year so you're getting long-term capital gains versus short-term capital gains. The biggest thing to note in all of the RSU grants is taxes. So you've probably seen you don't get taxed whenever the grant is awarded, but whenever the grant vests, you get the entire amount as income. So this becomes even more scary when we look at the tax changes that are coming down. We'll touch those just briefly in this meeting later on. So one of the scariest times in your career is deciding when to call it quits and making sure that you'll have enough money. I help my clients build secure plans to make sure that they'll be able to live the life that they want. Most MDs I've seen take two paths. The first one is pretty clear, it's retirement. The second is financial independence, which means you're probably going to be making money doing something afterwards. You may be starting your own business. You may be taking a less stressful job, going into nonprofit, lots of options. But even the retired Accenture folks that I see are usually so darn ambitious that they don't actually spend much time in retirement. But let's talk about strategies for both of these. So for retirement, this means you're going to have that one chunk of money that you're going to have to live off of. So it's important that the first thing you do is get a rough budget of how much you're going to spend every month. Then look at all of the assets that you have saved up today. So this is your 401k, your IRA, your brokerage accounts, and apply what we call the safe withdrawal rate, which is, it's been a number that's been studied for a long time that financial advisors use to say how much money can you pull from your investment accounts without putting your retirement longevity at risk. So typically that's 3 to 4%, and kind of customize that based on the client situation. The most important part after that is optimizing your account usage. We'll get into a case study and an example next, but it's really important to make sure that you're pulling the money from the right areas. I have a retired client that I'm working with right now, and just by changing the way they're pulling money for income in retirement, we're saving them $6,000 to $7,000 a year in taxes for the next 6 years. So this stuff is really important. The other path that I see is financial independence. This one can be a little bit simpler on the math because a lot of times you're going to have a paycheck again. It may take a while though, especially if you're doing something like starting your own business. So you need to get an idea of how much cash that you need to do this. What's the total the amount that you're going to need to start the business? How long are you going to be without a salary? You need to factor that in as well to make sure you build that cash runway to enable you to succeed without putting you and your family in a tough situation. So let's get into a case study, and I'm going to share a few things with you and get into some strategies that you can start doing today. It wouldn't be an Accenture meeting without a PowerPoint slide, so we have that here, but also it wouldn't be a meeting without a sweet Excel spreadsheet. And I kind of love Excel, not to brag, but back in the day, I actually made a resource model for CHT that I think they used for a couple of years. Hopefully they're not using it anymore. So for this case study, we're going to look at Faiza and her family. She was promoted to MD L4 in 2018, has since been promoted to L3. Her and her family want to explore a 10-year scenario of retirement versus financial independence. And she is currently 44 years old. So let me pull up my spreadsheet. All right, so here it comes. It's a lot to take in at once, but let's start by focusing over here on the top right, which is the dashboard. This gives us a 5-year and a 10-year view of how much money you're gonna have available between your extra cash flow and your investments and your equity throughout the years. These numbers factor in taxes. They also factor in annual expenses. And so this is an attempt to have a pretty good number. And then we'll look at the bottom here to see how this impacts your safe withdrawal rate. I know you're probably going to be comparing this to where you sit today and how much you make. I'll share an opportunity at the end of the call where you can set up a free consultation with me. So you don't have to try to do this on your own, but instead we can spend 30 minutes together and start getting into your particular situation. So as an L3, Faiza is at $390,000 on her salary. Bonus, I just put at 20%. Equity, I put at 25%. I know it's a little different than the bands, but just for simplicity's sakes. We have her family's annual expenses at $180,000 per year, increasing at 2%. Tax rate of 37%, which is their marginal rate combined between state and federal. Annual raise at 3%, investment return 7%, Accenture return at 8%, and she's contributing the full 30% into her VEIP. She made promotion in 2018, and this is her current savings today in her 401k, $350,000. She contributes $19,500 a year, which is her max until she turns 50, where you can do more. And then other investments, they currently have $200,000 today. So with all of this combined, we look over here back at the dashboard. It says in 5 years, their total with 401k will be something like $2.2 million, which is great. But at 10 years, this is really where we see the impact of Accenture equity. They'll be up to around $5.1 million at 10 years. And so we have our number of how much money do we have. Next, we need to think about how much we're going to spend in retirement and how much money we need to live off of. So right now we're at 180. If we use that number, you may not be able to see this because it's pretty tiny, but in 2027, $130,000 available if you're living off 3.5% is a safe withdrawal rate that I have here. But if we want the full 180, we have to go out to 2029, 2030, so about 10, almost 9 or 10 years out. At that point, they're looking at about $204,000 per year that they can safely withdraw. So then let's go back to the presentation. We're talking about strategies now of how you can make that money work. Because it's one thing to say, oh, great, I have this big pot of money, but it's a whole other thing to actually strategize and make it work for you. All right, so how would retirement work? We know that we have about 5.1 million to work with. The breakdown is about 1.5 million in qualified accounts, which is your 401k, your IRAs, that kind of stuff. 600,000 in the Roth accounts, which is a great savings number, and $3 million in after tax. So this is after their 10-year projection. Markets go up, markets go down, so we can't ever guarantee the rate of return. So it's important to build out these portfolios with proper asset allocation, making sure you have the right balance of investments, all that kind of good stuff. So you need to have a strategy for that, then a strategy for withdrawal based on the age and your need. So this might be a bit of an eye chart here, but we're going to break it down by different age groups. They want to retire at 55. You may say, wait a minute, you get the 10% penalty if you start pulling from a retirement account at 55. You're correct. And so we're going to talk about other strategies outside of pulling from your retirement accounts of how you can make this work. Between 50 and 59, the best way for their family to be able to generate enough income to live off their investments is going to be to sell stock. We talked about their after-tax account has something like $3 million. And so they have a good amount of money in there. But this is where we start getting into some of the secrets and some of the strategies. If you're only living off your stock and you're selling your Accenture stock, if you keep your combined income under $40,000 as a single person or under 80 as a married filing jointly, you pay zero tax on your capital gains. And I know that you may say there's no way I could live off $80,000 a year, but these are just $80,000 in gains. So if you sold $180,000 in stock, but only 70,000 or 80,000 of that was in gains, you wouldn't pay any tax. I know this is probably mind-boggling for you right now, because especially if you're in the East Coast or West Coast, you're in something like a 45 to 50% tax bracket. But this is where these strategies get really valuable. Another thing you can do between 50 and 59 is to start strategizing how you're going to move your money from your IRA to your Roth accounts. We'll look at it at age 72, but there's a problem when your IRAs are getting too big and your 401ks are getting too big. The money you take out is taxed as income, and it can have some major impacts and actually put you into higher tax brackets even than what you're in now. And so there's another strategy of being able to convert into the Roth account, but whenever you convert, that amount counts as income, and so we'd have to balance that versus the capital gains piece. If we looked at taking from the after-tax accounts, even if you pulled 5%, you'd be able to pull $150,000 a year, which is still only 3% of your total portfolio. So the next stage is from age 60 to 71. Much the same, except you have access to your retirement accounts at this point without the 10% penalty, but any money you pull out will be taxed as income. So you can continue to live off of your capital gains, but you can also start pulling some money out of your accounts here. You just have to watch your income to make sure you're managing the taxes correctly. Age 66 is the next big change. That's whenever you start receiving Medicare. And you have to be aware of a tax that very few people know about called IRMA, which is essentially a Medicare premium. If you make too much, you can hit up to an extra $1,000 a month in IRMA premiums. So this is also a big deal. You want to make sure you're successfully managing the money that you're pulling out. For most of you, it's going to make the most sense to delay Social Security until you're age 70. Once again, this isn't specific advice, but just in general, that maximizes how much Social Security you're going to make. And it also gives you more options between age 60 and 70 on doing conversions, living off capital gains without impacting your taxes. Then age 72 plus, the big change here is now you have required minimum distributions, RMDs. And this is where you're forced to start pulling money from your big IRA and 401k accounts. In our example, originally the account was 1.5 million. In 17 years, if it grows at 7% per year, that account's going to be up to $4 million. There's a table where you can calculate your RMDs, but it's roughly 4% the first year. And so all of a sudden at age 72, you're forced to pull out $180,000 of income from your IRAs. This is going to shoot you up in tax brackets. It's going to cause Medicare premium increases, and also your Social Security benefits are going to be taxed. And so that's what it's important that we talked about earlier, some strategies for starting to take money out of those accounts now and not take them out, but convert money from those accounts to Roths. And this gets into a lot of things now. We'll talk about some tips here in a second, but Roth accounts are really valuable. I know a lot of people focus on the tax deferral element because it's nice that you're getting that now with those big paychecks and big taxes, but that can begin to impact you down the road. Okay, that was a lot of stuff. Now, as promised, let's get into some specific actions and items that you can look at today. The first is utilizing the health savings account. To get a health savings account, you have to choose the high deductible healthcare plan, which all three providers offer to you. Once you have this, you can start investing into this account. For an individual, $3,600, for family, $7,200 in 2021. So many people mistake this account for the flexible spending account, the FSA, but this is totally different and it's way better. The HSA allows you to build as an investment account through the years. It doesn't reset every year like a flexible spending account does. So essentially, this becomes an investment account. And where I get really excited is that this is a triple tax advantaged account, meaning the money that you put in is tax free. You get a tax deferral on it. The investments that build up over time, those don't get taxed. And then when you spend the money, as long as you spend it on a qualified healthcare expense, it's also tax free. And so the example of $2,664 is if you maxed out $7,200 in 2021 and you're at the 37% federal rate, that's how much you would save in taxes. Some states do provide a break on HSA, others don't, like California. I know we have some Californians on here. Your tax situation is probably the most difficult, sorry. Another thing to know is Accenture contributes $500 to an individual or $1,000 as a family into the HSA. So just kind of a nice little bonus there. Once again, this is just scratching the surface. There's a lot of strategies with the HSA. One example is that you don't even have to reimburse yourself for healthcare expenses in the year if you don't want to. You can just let that money grow and grow and grow. If you keep the point, if you have it invested, there's a chance that money might have doubled. So that's a pretty cool option. All right, let's get into the next item, which is the after-tax 401k. Don't feel bad if you've never heard about this one, because once again, your telephone might have been broke, as we say with the old telephone analogy. So Accenture allows you to contribute up to $15,000 per year into this after-tax 401k account. This is on top of your $19,500 that you can contribute today into your regular 401k or your Roth 401k. Then, of course, if you're over 50, you have the $6,500 catch-up that you can do. You don't get a tax benefit on the money that you put into the after-tax contribution. So if it's $15,000, it's after tax, so you're paying taxes on it, then you put it in. But the earnings that grow on top of that $15,000 are tax-free, are tax-deferred. And so they're like the earnings in your 401k that they continue to grow until you use them and then you pull out, they're taxed. But there's one really important part of this that makes it a really great opportunity, and that's that you can convert within Accenture using the in-plan conversion. You can make this after-tax 401k a Roth 401k. So you're essentially creating a mega backdoor Roth contribution. At your salary range, you don't get to contribute to an IRA, to a Roth account besides to your 401k. But this allows you to add another $15,000 a year into your Roth. And like we talked about in that case study, that Roth is incredibly powerful because when you pull the money out, it doesn't count as income. It's not bumping you up in higher income brackets like the 401k or the IRA withdrawal. So you can do this through the benefit center. You have to call them to be able to do it. It's hard for me to show the full value of the Roth IRAs here, but just know now that it's a good option that you have. The next is a donor advised fund. I love DAFs or donor advised funds because they allow you to really amplify your giving by really creating your own charitable trust organization. So you set up a DAF through a brokerage account. Once you contribute money to the DAF, you've given up ownership of it, but you do control how the money is dispersed. And so you can give it to any qualified 501c3 as you choose. This becomes a strategy whenever you decide to bunch your donations in one year to offset a high income year. So let's use an example. Let's say that your new MD grant is vesting this year and it's worth like $350,000. I think it was the latest number that I saw for the 2016 grant. Your income is going to be really high. So once you're itemizing, so you have to be over the standard deduction amount, all of your charitable contributions are taken off of your highest tax bracket, your marginal tax bracket. And so this is state and federal, even California allows this. But if you're in the highest tax brackets and you contributed $20,000 to a DAF, it would save you something like $10,000 in taxes. Another incredible opportunity here is that you can give appreciated stock to the DAF. So if you're like me and you bought that Accenture stock back at like $17, $18 a share through the ESPP, and now we're almost hitting $300 a share, you have $275 per share in capital gains that you would be exposed to. If you were to sell it, you'd pay your 23% capital gains, and then you could give, but you're losing a big chunk. If instead you put that directly into a DAF, you get the full value of the total amount. It's not your cost basis of, say $5,000, it's the full $20,000. So DAFs are huge. And then you can do this now in your working years and decide later how you want to just to give the money out. And this is investable too. And so this stuff can grow. I get really excited about this stuff. The fourth option, the fourth strategy here that I want to share is most MDs I work with are first generation wealthy, and many are first generation Americans. So you have an incredible opportunity as a managing director to set up future generations for success and also potentially avoiding estate taxes down the line. We'll talk about in the next slide. Right now, estate taxes the exemption's really high, but that could be changing. There's two main tools to look at to do this. The first is a 529 plan, which is your education savings plan. And the second is the UTMA, the Uniform Transfer to Minors Act, which basically allows you to set up a brokerage account under custodianship for your kid. The 529 lets you put money in to an account, and then some states allow a small deduction, so that's nice. But then that money grows tax-free, and then whenever you use it on qualified education expenses, it's also tax-free. Right now, the limit is really based on the gift tax, and so you can do $15,000 per year. And there's another option called super funding, and that's what this $75,000 number is. This is where you can contribute $75,000 this year into a 529 plan. That means you can't give the next 5 years. You're basically pulling it all up now, but then that grows over the next 5 years. When we're talking about multi-generational, of course, this is great because it's used for your kids. But if you set up a giant 529 plan and say in 20 years, all of a sudden there's like $1 million in it, your kid may only spend like half of that, or maybe even a quarter of that, maybe even less. And so that account could have a bunch of money in it still. It is a challenge because the money is in there, and if you want to take it out, you have to pay taxes on the earnings, but you can take out the contributions. But instead, you can simply keep the beneficiary as your kid, and if they have kids someday down the road, they could change the beneficiary to their kids, and you can keep doing that. And so if you have this massive account built up, you can feasibly go multiple generations that you're paying for education now. So really powerful strategy there. The UTMA is another tool that you can use. This is essentially a trust for your kid that you set up. Once you put the money in, it's theirs, and they have access to it depending on the state at their age of majority. It's somewhere between 18 and 20, 21 years old. So in a strategy that I use with clients on this is that you can transfer your stocks to the UTMA. The cost basis transfers over. So let's use the example we used before with your Accenture stock. Say you had $15,000 of Accenture stock that you moved over. The cost basis was $10,000. So it's gone up 50% in value. This is now sitting under your kid's name in their UTMA account. Your kid is allowed $1,000 a year of unearned income without getting taxed. So this is unearned income would be dividends or capital gains for selling. And then the next 1,000 is taxed at 10%. So there's a strategy here that you can start transferring wealth today to build up opportunities for your kids, but also to start minimizing the impact of the estate tax. So just about 30 minutes in, this is what I was hoping for, to do this first part in 30 minutes. We've really just scratched the surface on things you need to do and think about as an Accenture Managing Director on your road to retirement. I mentioned a free consultation. If you would like to claim one, you can go to adventurewealth.com/services, but we'll drop a direct link to my calendar in the chat where we can discuss your situation in detail and see how my offerings can provide value for you. If anyone has any questions at this time, you can drop them into the chat. And so I will open up the chat. Another question, subscribing to the email lists. When you subscribe to that, you'll also get an email that lets you download a link to the Accenture Managing Director Playbook. I know some of you probably have this now, but if you don't, this is a 30-page playbook that I created that gets into more details and strategy on Accenture Managing Director compensation. So people find this very valuable. And so I just dropped that one into the chat as well. Some other questions that I get a lot. One is about the VEIP. I mentioned the telephone line. No one really knows exactly how valuable that is. I think a lot of you do, and a lot of you max it out. But even if Accenture stock went sideways for 2 years, and you, at the end of that time, your 50% RSU grant essentially gives you like a 22% return per year, which is not guaranteed, of course, because it's in a single equity. But you're not really going to get better options than that with investing. So as long as you can manage the cash flow situation, the VEIP is a really great thing to use. Another question: what percent of our total portfolio should our Accenture equity represent? Ballpark guidance: should we periodically be selling the percentages as they tend to grow very quickly? So there's a couple things to look at. Typically a single stock, you don't want it to be more than 10 or 15% of your portfolio. A lot of you know what happened back in the Arthur Andersen days. That's always a risk. We've seen things like that happen. So you don't want too much of your stock, too much of your money in a single company stock, especially for you, because you're getting all of your salary from there. You're getting a lot from Accenture. So the challenge is how to harvest that, how to sell that without creating huge tax opportunities, if you will. So a lot of MDs that I work with will come up with these selling strategies. A great way to sell is whenever your RSU vests. At that point, you're paying the entire income tax right away, no matter what. And so you've paid all the taxes on it when your RSU vests. So if you sell at that point, there's no additional hit. The additional hit becomes whenever those stocks start growing and you are essentially creating capital gains. And if you sell within 1 year, you get the tax at the same rate as your income. So whatever you do, try not to sell within a year. But if you wait more than a year, then you get taxed at the long-term capital gains rate. And so I've talked to a lot of MDs, and a lot of people will keep all their money in Accenture. And it's worked out really well. The compound annual return over the last 10 years is like 17% per year. Like I said, we're knocking on the door of $300 a share. And so it's been great, but it's that risk versus reward piece. And so I like to work with my clients to help diversify their investments. I hope that answers your question. Let's see. Another question that I get is, do I work with all Accenture employees? I focus mostly on managing directors. Like I don't want to take, I'm limiting the number of clients I take essentially. And so I can bring the most value to MDs. So if you're below that, senior manager, associate director, you've obviously done very well. And if you have questions or you're coming up, as an MD, then we can definitely talk about, how I could provide guidance and help there as well. What are fees for your support? This is something that I didn't want to get into too much just because it felt salesy, but I can cover them real quickly. And then also if you go to adventurewealth.com/services, you can see the fees detailed out. So I talked about the 2 different offerings. The first one, financial planning. This starts at $500 a month. It's an annual contract. And so for the year, that'd be $6,000, but it's paid on a monthly payment. This goes up based on complexity. And so we'd have our first meeting. I would send you back with a 1-pager to fill out about your specific situation. We would get into our second meeting, which also is a free meeting where we'd start talking about strategy and specific solutions I think could help you. At that point, I would be able to provide my fee. The second one is the assets under management model. So this is an AUM. This is really a traditional investment fee that most people working with advisors would be familiar with. My fee starts for the first million is 1.25%. So these are funds that would be managed in a custodial account. So I can manage them in TD Ameritrade, Charles Schwab, or Fidelity. And at that point, I would really have the execution of the investment strategy. So it starts at 1.25%. And then as it goes up, the next $2 million, it goes down to that is at 0.9%. And the next $2 million goes down from there. So it was an honor and a privilege for me to talk with you today. I know you're very busy. I'm always impressed with the work that you're doing. I know the utilization last quarter was something like 94%. So I know for you, that means it's probably more like 150%. So take a moment to really congratulate yourself on what you've accomplished and what you've been able to save. I'm always impressed working with MDs on that. So I will send all of this out afterwards. And thank you for joining me today.